Today we go over the new holding I just added to my portfolio. Go ahead and take a mental screenshot on the right here where my mouse is, where it says holding weighting, and we have two holdings, that's Salesforce and Amazon, and then the third holding is Crocs. I know, right? You might be saying Crocs. Crocs like the shoes? Yes, I'm talking Crocs like the shoes. Now hold up, don't turn off the video, stop what you're doing. Stop your judgments. Stop all the biases, negative ones that you're going to have against this. We're going to show in this video why this is my next 2x stock. If you don't believe me, just stay to the end of the video. I'm going to give you some quick bullet points why I believe that is. I may be wrong, I may be right, but either way, I'm throwing some money into this investment and we'll find out the hard way. How I actually originally came about this investment was a few months ago. On June 2nd, 2022, Dumb Money Live came out with this video that said, quote, "Why we're buying a stock that Wall Street hates." And I was interested. This video title caught me off guard, and I watched the full video, and I liked what they had to say. It was about Crocs stock, and I thought it was interesting, but I kind of shunned it off to the side. I put it on my watch list, but I never got around to it. Well, a couple months went by, and now we're in September, about 3 months later. I finally got around to fully researching this as I found another YouTuber post about it, and then as of today, I just invested 100 shares in this portfolio into Crocs stock. So we're going to talk in this video why this is, why I just bought 100 shares of this company, why I think it has a great opportunity to double or at the very least go up significantly. We're going to talk about its moat, we're going to talk about its valuation, we're going to talk about its growth, we're going to talk about lots of fun stuff in this video. So if you want an interesting take on a company that practically no other YouTuber shares opinions with, this is the video for you. You typically see videos about popular stocks like the Teslas, the Amazons, like myself who's invested in it, but it's very rare you get to see a deep dive take on a smaller niche company like this, especially one that has a negative connotation around it. If you haven't seen me before, my name is Jordan. I'm a millennial investor. I have these portfolios that I shared down below in the description, as well as opportunities to get awesome savings accounts, credit card referrals, and lots of fun stuff like that. So check that out if you haven't down below. 125 people have signed up with this link so far, so feel free to do so if you haven't already. But without further ado, let's go ahead and dive into Crocs stock. So for starters, Crocs stock, the actual price of the company, has went down and down and down. Its previous high was right about 180 bucks at the turn of the year, and today I bought it at $76 a share. Now I always like to share my portfolio balance in each video, and as of the time I'm filming, we're back up above 40,000. We were just 39 yesterday. We jumped huge today, and part of it because of Crocs going up as well. But we're up to almost $42,000 now, and then here's my performance and my track record so far since joining this portfolio. But jumping back over here to Crocs, with its original high last year being $180, today I bought it at less than half that price at $76, and today, after today's close, we finished out at $80.62, up $2 on the day. Now, what is my reasoning for owning this company? Well, you may notice, if you look at the revenue chart here, notice that in the last quarter or two, it's exploded, much higher than it had been previously. And the reason is because of the big acquisition that this company just had. Now, they did have a big influx of revenue from things like TikTok, but the main reason is because of their acquisition that they just did with Hey Dudes. They bought out another company, another shoe company, which I'm actually an owner of those shoes. I love Hey Dudes. I love wearing them. I wear them into work at Paycom all the time, pretty much every single week. And they paid $2.5 billion in this company. Now, we'll come back to that in a second. Now, the company's forecasting major revenue growth. I know it's very easy to look at a boring shoe company like this and just think, oh, this company's not growing at all. Well, first off, take out these two quarters. The last two quarters right here of $660 million, and then especially the last one, $964, factored in the acquisition. Everything on this chart other than these last two numbers right here have nothing to do with the acquisition, and it's just Crocs Shoe Company itself. And in the last couple of years, since about 2019, this company's really turned things around and starting to go upwards. Same thing for its profitability. Free cash flow around that mid-2020 time is when things really started to get profitable, producing $100 million plus in free cash flow every single quarter. And then the last year, if you look at the year chart, you can see that the growth for profitability and revenue growth are pretty substantial. Now, if we go ahead and take a look here, you can see that they're forecasting dramatic growth for both brands, both their old hardcore old school brand as well as their new acquired one. The projected revenue for Crocs is projected to be at about 2.5 to 2.6 billion, and then Hey Dudes is going to be about 850 to 890 million. So basically this company is going to do around 3.4, 3.5 billion or so, and that's pretty decent growth considering both of these will be growing double digits, including the Crocs brand, which implies a 14 to 17% revenue growth on a constant currency basis, not factoring in that stronger dollar that we've had the last couple of years or so. Now, if you look at the long-term revenue growth, it is great for both of these companies. That's not what I really care about. What I mostly care about is this bottom line, long-term adjusted operating margin at 26% for both brands. So this is what's so key here, is that not only did they acquire Hey Dudes and that's going to increase the top line, what I really care about is the bottom line right here where it says accretion, immediately accretive to Crocs earnings. Expect 700 to 750 million of PF 2022 revenue for Hey Dudes. You can see that this company was purchased for $2.5 billion and it's now doing almost $1 billion in revenue already, as well as millions and millions of dollars of profit. Now that's not all. We also have this company's track record of buying back shares. Now, here's the key part. Let's go over here. We can look at all these metrics, and there's lots of good things about the company. There's one horrible reason why this company is valued so low, which we're going to get to valuation in a second. Actually, let's go ahead and jump forward. I want to go ahead and show that before I start talking about the debt. I changed my mind. Let's look at Skechers. This is one of the key competitors for Crocs, one of their main competitors. And Skechers currently has a $38 share price and has an estimated earnings per share in 2022 of $2.71. This gives this company a forward PE of about 14. Now, what is Crocs PE? They're expected to do about $10 in earnings per share. Their forward PE is an 8. So they're trading almost half the price of Skechers. Half. Not 75% or 80%. They're trading almost 50% lower than Skechers on a valuation basis. Now, what is the reason why this company is valued so low? And that is because of this right here, which is the nasty long-term debt from this acquisition. They increased the long-term debt right at about $2 billion from acquiring Hey Dudes. Now, here's what's interesting. Notice that in the quarter-over-quarter numbers, they paid off $110 million of long-term debt just in one quarter. At that rate, they'd be paying off almost $500 million a year if they were to keep up that pace. Now, we're going to get an update here in just a couple months for the next quarter, but I think they're going to increase that even more so. Why do I think that? Well, that's because of this line right here. It says commitment to use excess free cash flow for debt repayment, no share repurchases in 2022 until gross leverage is under 2x. Now, here's what's so key. This company had previously, it's never issued a dividend. What it had done is it had taken its profits and it's returned cash to shareholders. In 2017, $50 million. In 2018, $63 million. 2019, $147 million. 2020, $170 million. This company continually buys hundreds of millions of dollars of shares back to its shareholders, and this continually increases shareholder value. But instead of doing share buybacks, they're now going to be buying back that debt. So the one reason why this company is valued so low is going to slowly go away as they buy back that debt. And I think that the valuation is just getting started. So if this company is trading at, say, an 8 PE now, if it were to get up to, say, a 12 PE, that means that this company would need to go up 50% in value to $120 a share. Not to mention they're still growing. So this is a company, if they continue to execute, if they continue to grow, and then more importantly, valuations continue to expand for this company, we could very easily see a double up from my share price of $76 a share. If they were trading at a 15 PE and they grew 10% next year, this could easily be a double up from where we're at today. So this is why I'm buying Crocs stock. I'll be talking more about it in the future. This was just some basic bullet points, but if you haven't checked out the stuff down below, do your own research in the company and let me know what you think. Check out all the stuff down below in the description. But other than that, guys, I'll catch you guys next time.